Thanks very much, and thank you very much, everyone, and really appreciate you taking the time to come and listen to what we have to say today. So again, just by way of introduction, I'm one of these guys that spent probably 15 to 20 years in investment banks, sitting on equities and fixed income desks, dealing with institutional investors and also dealing with private client advisors. So I never really ran money until about 10 years ago. And it was more about providing services and helping sort of build the Australian hybrid market and running derivative plays and helping large clients risk manage. The attraction of coming to Shores together with my business partner, Cameron Duncan, who also had the same background. I spent a lot of my time at Citigroup and Merrill Lynch, Commonwealth Bank of Australia. He was mainly at Macquarie Bank as a hybrid specialist. He came from the fixed income market. I came from the equities market. And what we basically wanted to do is come to shore and help build out the managed account platform, not just on hybrids or equities, but across all assets. So we oversee, together with Martin Crabb, who's our Chief Investment Officer, and we're joined to the hip with Crabby, and I'm sure you've either heard of him or heard from him or spent time in his sessions. And we built the portfolios 8 years ago. Crabby and I spent a lot of time doing these sort of presentations to investors and advisors. And we like to think that we've built a multi-asset, multi-strategy framework where we deal with the IAM guys, for example. We've dealt with Manning across all the asset classes. But when it comes to hybrids, Cam and I have specialised in that, and that has become a core part of our day as broker-dealers, originators, and also portfolio managers. So the trick was to come to Shores and build that offering around that asset class, but then more importantly, frame it into a total investment portfolio solution. So we're not just here to talk about hybrids. Why do hybrids exist? Hybrids are effectively a security or a structure that has elements of debt or equity that allows mainly financial institutions such as banks to tap a new investor base, whether they be institutional or retail clients. It's not fixed income. There's no guarantee that the distributions will get paid. You can't bankrupt the bank for not paying you a hybrid. It's similar to an equity dividend. However, there's big implications and no-nos involved for them to not pay distribution. And there's also a lot of a risk around them not redeeming or calling a security. And there lies the opportunity. It's not just the rate of return that you're getting, which is typically a higher rate of return as a margin expressed over the floating rate, the 3-month bank bill. They are floating rate securities. And the reason they're floating rate, once upon a time, believe it or not, 25 years ago, they were fixed rate because we used to sell these things to the fixed income fund managers. Roll the clock forward from about the early 2000s when it became a retail product as well as now an institutional product. Floating rate's important because the rate moves with interest rates and therefore less price volatility risk. As you know, with fixed income investments, as the boys will talk about, there is opportunity, but as you are getting a fixed income security, the price can move a lot more in theory than a floater. Hence why the hybrids are predominantly floating rate, especially the ASX listed hybrids. And they are traded down to $100 on the market. The other important thing is because it's an ASX listed market, as we've seen during the GFC, and we also saw during COVID, where other markets, over-the-counter markets, might find it at times difficult for liquidity. Whether you like it or not, the hybrid market's going to trade. Doesn't mean that the securities won't trade down. They always do, but there lies the opportunity. And you'll see in a couple of minutes the dollar cost averaging of that. But the bottom line is because of the rates of return and the way that the major banks predominantly are the issuers, and certainly in our portfolio, 85 to 90% of the 4 major banks, that's where we see the comfort from a risk return point of view in terms of the very little probability of loss, if any, in the long term, and the secondary market volatility, because we understand it, and as Brendan quite correctly said, because it's misunderstood, for us, it makes a lot of sense. Like everything in life and investments, you don't put all your eggs in one basket, but there is absolutely a role, in our opinion, for this. So just to quickly show you the rankings of where the seniority of security and risk sits, you've got your equity, which is perpetual. There's no guarantees you'll get your money back. You've got to sell it on the exchange to another buyer. With hybrids, it is an equity instrument, but it's what we call an equity derivative. So it definitely sits above equity in terms of the safety of it, but below the subordinated debt and corporate bonds that the IAM team will talk about. So this chart here I just pulled together. I haven't actually looked at this chart because we know it so well in our heads. The 3-month bank bill rate is really one of the fundamental pricing tools, or the BBSW rate, that prices not only all floating rate securities, but swaps, which is the forward-looking 5 or 6 year version of the security that the banks issue various instruments off. So what this is showing is that just like we saw it go from that 2.5 band all the way down to zero, who would have ever expected? I certainly didn't when I purchased a home around December of 21, that we'd now be facing bank bill rates of where they are at the minute. And obviously, when you then look at the other rates in the market in terms of the long-term swaps and the bonds, this is where investors are looking at this and thinking, right, I can use this or a cash-like proxy, but then I've got to determine whether I want to be invested in hybrids as an asset class or bonds or the like. What's interesting now is where we think the short-term and the longer-term interest rates are going to go, based on where we saw the RBA move yesterday, the whole 3.85. Obviously, inflation is a bigger problem than when we all thought. That's why we're in the situation. They made it very clear yesterday that there's no guarantees that they won't continue to go higher. The problem there is how does this drive returns, and where should we be investing in terms of the bulk of our profile and our portfolios. So when it comes to hybrids, the way that hybrids work, they're generally a fixed margin over a floating rate issued by a bank, let's say. So once upon a time, and we haven't gone all the way back to 2000 when Cam and I started, but back in 2000, the spread was 1%. 1% when cash was wherever it was, 6.5, 7. And we were getting rolled over in terms of billions of dollars of demand. The GFC, and we saw that again in terms of 2020, the GFC saw a short-term sell down, and I'll say short-term because it was only a 6 to 12 month period of depressed prices, but it can show you that the spreads can materially move out. And that does scare people, but the people that know the market welcome this, as we did in 2020, because from the dollar cost averaging perspective, it tells you that if you hold these things to maturity and the banks continue to pay distribution and you're not a forced seller, I'll say it again, you're not a forced, because the forced sellers were the ones that sold in at that period and also during the GFC, you will end up with a rate of return that even exceeds the 250 or the 300 rate of return that we think, as you can see from the chart, is now the long-term margin. So if we go back here, when rates were zero, people were saying, but hang on, I'm buying a hybrid, it's a floater, why should I buy it? Because I'm getting a low rate of return. Yes, you're getting a low rate of return, but you're getting a low rate of return because everything's going lower. But that 3%, the 350 margin, which we've generated, or a hybrid portfolio can generate, that kind of made a lot of sense as a reflection of the underlying base rate. So on the way up, you can't have it both ways. So people say, that's great, on the way up, well, should I not be moving out of this and looking at other things? Well, the answer is not really, because as an asset class, you're still going to get the benefit of that margin. And as long as you're comfortable in achieving that margin over a long period of time, you don't look at the hybrid asset class as a short-term investment because of that price volatility risk. But what happens is all the securities, and I've just illustrated the 19 or so major bank hybrids that we like to focus on, will pay a margin over the bank bill swap rate, plus where the implied bank bill swap is to that period. So your expected rate of return now is in the 6s for something that has very limited risk in terms of probability of not being paid at maturity. And then when you do an active portfolio, as you see in a minute, whether you're running yourselves or we're running or anyone's running it for you, the value add is you're achieving that rate of return consistently, and you're able to top up when you think the spreads have obviously widened, and likewise switch into bonds or equities. So it gives you this ability to take a 50-50 debt and equity portfolio through this portfolio and actually get a better rate of return in the long term than you would by doing what we all do anyway and having a diversified bond and an equity portfolio. It is an asset class that does that at obviously improved correlation. Liquidity, as you'll see, $40 to $50 million a day, that creates the opportunity as well. Whether Cam and I are the leading brokers in the market as well, we're dealing with the IM team, we're dealing with other institutional investors, we know the flow. That's why it's given us the comfort to set this portfolio up, because in the long term, the spreads from a risk-adjusted point of view are offering that rate of return commensurate with a total portfolio and de-risking the portfolio amongst the debt and the equities. So we basically started off in 2016 with zero from a blank sheet of paper, and today I'm happy to say that we're running approximately $1 billion in these mandates via an SMA structure and an institutional mandate, as well as helping the Shaw advisors, Brendan and the team, bid for the securities themselves in their own right with our advice. Some people want us to run the money, some people want to do it themselves, others want a combination of both. And the real value add for us is being able to understand the issuers, understand, more importantly, how these things trade in the secondary market, because that's the secret, and actively managing these things around the new issuance process. Every 5 to 7 years, the banks have to roll the securities, and that's where we put up our hand. We're a leading syndicate member, joint lead manager, as Cam was when he was at Quarry, as I was when I was at Citi and CBA and so on. But because of that now, and because of our ability to be in size into the books, we're an important participant, and we can help the banks come up with their roles and determine where pricing should be. And the opportunity around understanding the secondary market and also the primary market and the ability to take on an often. Typically, these things are priced to give investors a positive experience. What does that mean? On day one, they should trade a bit better than 100. They don't always, but in the last few years, they have been. You would have seen recently design and distribution rules around target markets and selling portfolios to these securities to investors and other securities as well. Comes with the ability to have to determine the market that you're selling it to. What that's meant for hybrids is a major bank can no longer go through its own retail network, send out 100,000 emails to their holders and say, would you like to participate? It all comes through the syndicate brokers, so we have visibility on the demand and supply of the portfolios. So the hybrid portfolio, the flagship hybrid SMA that we run, that the team's invested in, and I know some of you are as well. We've got 24 securities in there, so that's, to us, that's quite a lot of diversification, especially given we're managing a lot of money, and $1 billion means that if any given day we have a $10 million inflow or outflow, or we need to do a trade, we've got 24 securities in there, which is more than enough, rather than having 10 securities. And each one of these we obviously look at every day and make sure that in keeping with the slide I showed earlier with the levels, that we've got the right holding in the right part of the curve. And then we take advantage of market mispricing and new issuance to be able to generate a better expected return than the 3% plus RBA objective that we've gone out with. So this gives you an idea of when Cam and I first got here in 2015, we launched the portfolio. We did a lot of work, talked to a lot of industry specialists and other people around the market to work out, well, what should be the objective? And we thought the objective is 3% above RBA cash. So we've put ourselves to that. And you'll see over time, you get periods where you overperform, you get periods like the COVID situation, or when Bill Shorten was going to knock off the franking credits and cancel them, but obviously had a lot of people worried, particularly around hybrids, because it was 1/3 of the distribution. But in the long term, since inception, close to 8 years now, where the objective was 3.94% to the RBA cash plus 300, we're pretty pleased that we've achieved 1.5%. Where does that come from? From the active management, pretty much around the new issuance and the ability to buy and sell mispriced securities. You're not going to get that over a shorter period of time. There are times when the market, if you come into it and the market's already a little bit tighter or expensive than we'd like it to be, and you still think it's an asset class that makes sense. It's not as if in 12 months' time you had a negative return and it's time to exit. You've really got to be in there for 2 to 3 years to get the benefit of the new issuance and the active management. And then you should get 3%, not much more, not much less, above RBA. And that's where it does what it's meant to be doing. For some people, that's more than enough. And for others, they'll blend it in different ways. So this is one of my favourite charts that we started doing about a year ago on this whole point. And this is just a rolling return. So this says if you just give me the last 12 months and run it forward, how bad does it actually get? So you'll see that in reality, during COVID, yeah, there was probably 1 or 2 observations on a rolling 1 year period at the worst time in March of 20, where you're negative or you're below objective. But as you can see here, by and large, you're pretty much mostly, even on a 1 year basis, above the objective. When you start looking at 2, 3, 4, 5 years and so on, when you look at 3 years, which is a standard, I guess, for portfolio managers to be benchmarked, something interesting happens. You very rarely are you anywhere negative, and very rarely are you even below the benchmark. And that's what we're pretty happy with. It's consistent. You're not going to shoot the lights out, but you're going to get that 300 plus. And that makes sense at a time where there's excess volatility in equities. People that have been overinvested in equities for the dividends are looking at this now. With where rates are at the moment, your dividend yields on the ASX 200 and a hybrid portfolio, that's not that far apart from each other. Yeah, you haven't got the upside, but you don't have the downside either. Because of the way we work, we run it as an SMA, we provide the portfolio, the advisors will obviously work with yourselves, the investors, but we spend a lot of time doing fund manager style monthly report with a hell of a lot of detail in it. It should marry up with the report that you guys can pull out of Praemium, out of the system, so that at any point in time, we're fully accountable for what we do. And obviously your advisors, Brendan and the team, will make sure that they're right sizing your allocation into it. But the bottom line for us is it's an important asset class because it serves that purpose, de-risking people that have too much equities, adding a little bit extra to cash, term deposit and bonds. But over the top of it, it's an asset allocation decision. So it forms what we think is an important part of an income portfolio with all the other asset classes in mind.
Thanks, Steve. We'll might hold off until the end for questions if that's okay.
Yeah.
Thank you for that. Obviously, a bit of sophistication in the portfolio goes on behind the scenes that we take the credit for, which we're quite happy to do. But in saying that, a number of the real attraction points for this is the visibility, the transparency over the holdings, and as well as the ability to eke out the additional return with the risk profile that it's got. So it was a great area for us last year when we had an aggressive interest rate cycle. Floating rate was definitely the area to be in, and it still has, I think, a pretty good position in portfolios now as well. But thank you for that, Steve. And to introduce the next speaker, Matthew McCready. So Matthew is from Income Asset Management, Executive Director of Credit Strategy and Portfolio Management. He has over 10 years experience and previously worked at Aberdeen and Colonial First State. Matthew provides credit commentary on the bond market and specific issuers, holds a Master in Applied Finance degree from Macquarie University and a Bachelor's of Commerce from University of New South Wales. And to give you an idea where this is playing in our conversation, go back a year ago, we were never having this conversation. We did not really have access to this type of platform. Go back a few years ago, I don't think this kind of functionality was really available, whereby the over-the-counter markets and get access to kind of direct instruments like this was normally done at an institutional level with a lot of cost and a lot of uncertainty in a grey market. Income asset management is great for us in terms of producing ideas in the bond space, such as some great ones we've been seeing in fixed rates recently have been, for example, CBA and Challenger that are pushing about 6.7% fixed, that are now tradable over the counter, which is a very slick and easy process at a really cost-effective way. So you're able to build that transparency, you're able to build a really good income in some great names. And if we do get interest rates coming down, then you've got a bit of capital upside there as well. So this is another area where I think the risk-reward trade is quite strong. Again, it's something which we've only developed the capacity, the relationship on our side over the last year. We're getting more and more interest and demand in this space, and it fits a variety of different ways within portfolios as part of your fixed income allocation. So I might hand over that if you're okay to jump in there. And
yeah, sure. We'll get you start off and talk through the IM background. Yeah.
Firstly, thank you to everyone for coming in. We really do appreciate you taking the time to listen to what we have to say. Before Matt gets started, I'll introduce myself. My name's Jacob Brady. I'm part of the IAM Capital Markets team. I wasn't on the list, so it's all good for no intro.
Sorry.
But no, you, mate. But before we do get started, because we are new to the scene, I thought it'd be useful to, I guess, let you guys know how we got here. So in February of 2021 is when IAM officially launched. Basically our goal was to, to offer a complete fixed income solution for our clients. We have three main pillars of our business that you can see. The first one being capital markets, which is the team that Matt and I are a part of. Basically, that's where this over-the-counter bonds trading, which we've touched on, that's where it all happens. That's where we give access to primary and secondary market opportunities within the bond space for our clients. And our clients vary from high net worth, financial advisors, planners, corporates, and family offices as well. We also have a managed fund solution and our cash markets decks as well. So that's all the term deposits, that's all the vanilla stuff. But that's been there since inception of our business. So while we've been up and running since 2021 of February, the business has been in very different forms, up and running since 1987, which I'll touch on this next slide. So as I said, 1987 is when the business first formed, and up until then, until 2020 of April, it was purely a term deposit offering. So in April is when the board decided to take a much different strategic direction, and that's when our new CEO was hired, John Lechty. And his job was basically get an over-the-counter direct bond service desk up and running, and then I guess eventually form it into something much more diverse and extensive offering across the full fixed income spectrum. I won't touch on all of these, but it's worth noting, given that we've only been around since February 2021 as IAM, last in November of 2022 is when we achieved, I believe it was the first in the business history since '87, EBITDA positive in Q2. So given we've only been up and running since 2021, and we all are very aware of the challenging economic environments we've been a part of, it's something that we hang our hat on, and it's really starting to show the fruits of our labor that we tried to endure when we first got started. So as we said, the direct bond service, this is the core of what we do in the capital markets team. So historically in Australia, bonds were only accessible in 500k parcels, which obviously cuts off a lot of investors from this asset class. I believe it was in the late 90s when there was a couple of providers that were able to step in and break these parcels down from 500k to much more smaller minimums, which obviously opens it up to investors like yourself, and it helps diversify portfolios extensively. This isn't a hot take at all, but bonds in Australia is certainly still a very underutilized asset class, even with the smaller minimums now available. But this does show, in terms of what we can invest for our clients, a very extensive range. We basically can invest across the entire capital structure. The tier 2 space is probably where we're seeing, Matt will touch on this, is where we're seeing a lot of value, as Brendan mentioned as well. But if a client comes to us and they're looking for something as safe as government bonds, or they're looking for something, they're chasing yield and they want some unrated issues, obviously we can cater to that as well. So basically like to think that wherever a void is in the client's investment needs, that's where we can plug in. This slide I'll just go over briefly. This is just to show the onshore and offshore counterparties that we have on board. So this is to basically highlight when we're buying and selling these bonds, we're able to access the best prices and liquidity because of the relationships we have with these well-known names. Obviously, a lot of these are very recognizable. But when liquidity is needed, and when we can, I guess, when an order comes in for certain bonds, we're able to scale the market to make sure we're getting the best outcomes for our clients. And lastly, before I hand it over to Matt, our custodial structure. Now, this is a question that gets asked to me pretty much every single day. When a client's opening an account with us and they want access to direct bonds, they want to know where their bonds are and if they're in a secure position. So to answer that, where the top of the structure is the Trustees Australia Limited, which is just our internal register of holdings. But the question, where are your bonds held? That's with JP Morgan. So the risk isn't with us, the risk is with JP Morgan. So we utilize all our custodial services through them. We also utilize Apex Group, which is basically all for all administrative purposes. So we don't do any of the handling of the funds. This is all between Apex and JP Morgan. So again, in the very unlikely scenario, if something was to happen to our business, which clients are well within their right to ask, the risk isn't with us, it's with JP Morgan, which gives them a level of reassurance. So I'll pass it over to Matt to talk about our credit market outlook, and also where we're seeing value currently for our clients.
Yes, thanks, Jake. So just on the outset as well, I think Steve touched on the hybrids piece, where we see bonds fitting into a kind of optimal portfolios. You've got cash TDs and bonds, and then you've got hybrids and equities. But I think it's not saying hybrids are better than tier 2 or tier 2 is better than hybrids. I think you should be considering both in a balanced portfolio, because they've both got different risk return objectives, and they both add a level of diversification and different income producing asset classes to the fund. So for instance, a lot of the tier 2 subordinated lines are fixed rate, whereas as Steve spoke about, the hybrids are floating rate. 1 year ago, fixed rates were extremely low, like 1 or 2% on corporate bonds. Now you're looking at 6 to 7% on fixed rate security. So for those investors who do think we're at a point where inflation has peaked, and maybe, the RBA doesn't think that just yet, baby, but adding fixed rate exposure where you're locking in a yield now, if you think inflation has peaked, is a good thing to do as an investor, because as we spoke about, you'll get capital gains upside on those securities, because a lot of those are priced well below par. Now, in terms of just our outlook going back a year, 2022 was a bad year for fixed income. So when I talk about fixed income, I talk about, fixed rate bonds, which have duration risk, and this is what we call sensitivity to interest rates. So last year was all about inflation, and bonds which have duration did do badly. So hybrids were protected somewhat because they were floating rate, but bonds and tier 2 was impacted. So last year, the composite index, which is our local fixed income index, returned for last year, I think it's around 10% down, and the ASX was down, I think about 15% last year. But if you look at this year, 4.6% year to date, and the ASX index is up about 6.31%. So it's been a pretty strong rebound this year. There's been a lot of articles talking about bonds are back this year. Now's the time to get back into bonds. And the reason is you're starting at a yield which is a lot higher than you were a year ago. So you've seen this big rates movement over the course of last year, driven by inflation and central banks, but you're starting off the year at 6 to 7%, and you're locking that yield in for the term of the loan, the bond. So as Steve said, a lot of the time, if you're not a forced seller of these bonds, you can hold a maturity, you'll earn that yield. It's only when you have to sell these bonds where you might have a capital gain or a capital loss at that point in time, because the bond can trade above par or at a discount. So that's the key thing for you to think about. And I think as the saying goes, the night is darkest just before the dawn. And the credit conditions this year are completely different to where they were a year ago. We have had that inflation spike, but you're now seeing growth decelerating. Yields are very high as the central banks have done a lot of tightening. And in that environment, if we do get to some sort of recessionary environment, bonds tend to do well, right? Equities are highly correlated with growth and EPS, and will get hurt a lot more than bonds in that environment. So there is a level of capital stability by holding bonds. Next slide. The headline there, generating income, it's all about yield. Income is back in the bond market. I think that's the key thing I wanted to point out there. We've got a model portfolio that we also track for investors. So we will disclose this bond portfolio to investors, which has a number of fixed and floating rate bonds, a yield of around 6 to 7%. As I said, last year it was about 2 to 3%. But we show investors what we think are our best picks and what we think is going to earn them the best return over the foreseeable period. We've seen a lot of new issues lately from the banks in the tier 2 space. So you've had the CBA and Challenger, which we talked about, but you've seen ANZ come to market. We've still seen some regional banks come to market, and the yield on that has been about 6 to 7%. And then the credit spread, when you look at versus government bond, has been about 250 to 300 basis points for not much additional risk. So Steve had a good chart there at the beginning showing the different layers of the capital structure. Subordinated debt sits above hybrids, so it's higher up in the capital structure, so less risk. In terms of coupon deferrability for tier 2, you can't have coupons deferred. So from an income point of view, and I don't think the banks will get into trouble in the foreseeable period, but if you're worried about income, tier 2 is good because you can't have your income deferred. The other thing is that the spread, or what we call the risk between hybrids and tier 2 at the moment, is only around 50 to 75 basis points. So it's quite thin compared to where it has been historically. So it's a nice time to add tier 2 within the fund, especially after clients may have had a good run on those hybrids. They might want to lock in some capital gains on those bonds at above 100. So a lot of them are trading 103, 104, 105, so they can recycle out of those hybrids into tier 2 if they want, or if they've got some spare cash sitting on the sidelines in TDs, then you can recycle into tier 2s at 6 to 7%. So, it's a good time to start looking at these products. And as we've talked about, it's an over-the-counter wholesale market. It's not a listed market, so it's slightly different in terms of how you go about accessing these products. So Shaw's, through the partnership with IAM, access the products on that front, and they can get access to the wholesale bond issues when they come to market. So one of the issues with the hybrid market, and I'm sure Steve knows the frustration about this, is sometimes you can get oversubscription in these products and clients are scaled massively, right? So you might not get what you want in terms of your allocation. With tier 2, the volume of these issues are huge, right? CBA will do a $2 billion tier 2 deal versus CBA doing a hybrid at maybe 500 million max. So you get 4 times the level of volume, which means you're going to get, if you want $1 million in that line, you're going to get close to $1 million. Whereas in a CBA retail hybrid, you're going to get scaled 50% or more in that line. This is our balanced portfolio. So we've got 10 names in that portfolio. 60% of those are corporates, 40% are financials, varying maturities, 1 to 5 years. A lot of these names are what we call investment grade or triple B. You can see there that a lot of them are household names. CBA 2033 was the new tier 2 bond they did with a coupon of 6.704%. We had the ANZ 2033 with a coupon of 6.736%. And then we've got a line in there, Suncorp, which did a 2028 callable bond. So what we've tried to do with this portfolio is build a mix of fixed and floating securities that gives you 6 to 7%, but also doesn't have too much interest rate risk. We wanted to have some floating rate instruments to hedge some of the duration. So that's why we've added those in there. But you also get access to corporate. So Lendlease, for instance, is a strong corporate in our market. Ampol, Air New Zealand and Horizon. And these corporate lines, because they're quite long duration, as I said before, the price has dropped dramatically on those lines because they're interest rate sensitive. But at this point in the cycle, where we are in the rate cycle, you're going to see some capital gains in those products going forward. This chart here is just showing where we are kind of in the fixed income allocation orbit. So I like to look at this because investors want to know, well, where are we in the monetary cycle or rate cycle, and where are we on the economic cycle, and are we nearing a recession? A lot of the time, the question I get is, when do you think's a recession coming? What should I be doing in that environment when there is a recession? How should I be shock-proofing my portfolio? What should I be doing? And, bonds are a great, place to put your money if you are worried about a recession. I'm talking investment grade bonds, not high yield bonds, because that's a different story. But having an investment grade portfolio of defensive names can shock-proof your portfolio through a recessionary environment. Now, 2022 was probably one of the only years in 35 years where you didn't have the correlation of bonds and equities didn't act how it's supposed to act, right? And this was largely due to inflation last year and how central banks have artificially lowered interest rates over the years. But we still expect going forward bonds to act as that defensive attribute to a portfolio. So what we would be saying to investors here, we're kind of moving across that circle post-banking crisis into an area where we've got low growth or even a recessionary environment. But we're also starting to get to a point where there will be at some point net easing. Some people have factored in rates easing the back end of this year and early next year, but we're getting to that point where you need to start thinking about, well, what happens in a rate easing environment? Because the market is forward-looking, right? And the market will look at the moment, they're seeing inflation, but they're seeing the fact that central banks will start to ease at some point, and that will need to be priced in as well. So you want to be one step ahead of what happens and manage your portfolio accordingly in that environment. So Australian major bank tier 2s, I think why we like them at the moment is mainly on the back of, you've seen a lot of issues with Credit Suisse, Silicon Valley Bank and First Republic lately. We think the Australian banks are very differentiated from those offshore European banks. 3 reasons. One, extremely well capitalised. We know about this unquestionably strong capital ratios, but the banks are so far ahead in their capital requirements versus the rest of the globe that they're protected. The second thing is the banks don't have trading books like they do in the US and Europe. So a lot of the issues where these offshore banks got into trouble recently was they had fixed rate bonds, which I talked about duration earlier, but they're sensitive to interest rates, and then interest rates went up. These bond portfolios they held dropped in value, and then you lost confidence in those banks, and the customers basically were like, well, I'm going to withdraw my funds if I can't get confidence in your asset value on the balance sheet. So the Australian banks don't have that issue, right? We don't have trading books like the European and US banks. The third reason is the regulator. APRA is a very proactive regulator who takes a lot of steps prior to getting to any point where there would be trouble within the banking sector. And so this should protect subordinated bank instruments. And when I say subordinated bank instruments, tier 2 and hybrids to some extent, they're still protected because of the credit strength of the banking sector. So that's why we like the Aussie bank tier 2s, but also in the investment grade space, we like corporate credits which have defensive characteristics and are fairly lowly geared in this environment. So what I mean by that is credits which are, say, have inflation-linked pricing. So like a Transurban issues bonds where they can price or their cash flows are linked to inflation. That's one instance. Or Lendlease, which has properties which have rental agreements which are linked to inflation. But also defensive style assets. So Lendlease has properties which have very high occupancy. Transurban, people need to use those roads to get around. You're not going to have a lot of volume risk with those sort of names. So they're what we like outside of what you would call those financials in that investment grade space. I think that was it from me.
Thank you. So appreciate that. So again, area that has been, I think, in conversations only really over the last 6 to 9 months for us. It's a new capability, I think, that's only improving in terms of idea generation, execution, solves a massive problem for a lot of people, I think, who are looking for defensive income, reliable income. Once they understand the process, they're really, really warming towards it. So we like putting on these nights that bring people closer to the people on the other side of the actual execution and the model to learn a little bit more about that. But in saying that, I'll now get ready to hand over to Josh. And Josh Manning is the founder and portfolio manager and investment committee member for Manning Asset Management. He's over 15 years experience in investment management before founding Manning Asset Management, and has extensive experience in originating and managing complex investment products on behalf of clients, many of which have been underlying lending component. Josh is active in the Australian fixed income industry as a member of the Australian Securitisation Forum. Geez, Josh, you got everything here, mate.
Busy person.
Has an MBA from Macquarie Graduate School of Management, Bachelor of Business from Macquarie University, and is qualified accredited derivatives advisor. Now, in terms of the fund, we've done a lot of work. Now, credit, I think, is an area that has normally a little bit of a squint in the eye from a lot of clients, in that it can mean a lot of different things. And I think a lot of times when people look at lending, they normally assume it's from a bank. The reality is that the last 5 to 7 years, the banks, under the new requirements, do have to hold up a lot more capital. And so their ability to lend has been massively reduced. And there is an ocean of opportunities in good quality businesses in areas that are lending opportunities to make money, such as funds like Josh. So it's an area that I think is really blossoming. And we've done the work, I think, on Josh's fund, which is rated from Evergreen, I think recommended rate from Evergreen, and also been diligently kind of run through the ringer through Brad Matthews, who's our external kind of analysis consultant. And we're more than comfortable. And the problem, I suppose, the benefits of what it provides us with is regular monthly income, reliability and lower volatility, all attributes that people are kind of warming towards at the moment. I think we've done about kind of close to 8% for the last year. It's probably 6.5% annualized longer term.
That's right.
So again, part of a portfolio that we're quite excited about, and obviously a good opportunity to hear more about the people behind that to get more comfort with this space and more interest and excitement around that as well. So without further ado, Josh, you take it.
Thanks, Brendan. Thank you everyone for your time today. So yeah, Josh Manning, founder and portfolio manager of Manning Asset Management. We have 3 credit portfolios that we manage. The main fund is the Manning Monthly Income Fund, which I'll sort of center my discussion around today. So today, the topic is obviously generating yield, and I thought it'd be helpful to just give a bit of a overview of how we're seeing Australian credit markets today. Where are the risks? What are some of the things that we're seeing at the moment? So across the 3 funds, we finance about 2.5 million individual loans, and on a monthly basis, we're getting loan tapes from a lot of those originators that give us a status of where those portfolios are at, where the arrears, what's the loss rates, all those types of granular details. So we get a very rich data set that we quantitatively process on a monthly basis that informs our decisions. But the other really interesting one, I mean, over 90% of the market of financing that happens in Australia is done by the Australian banks. So we've spoken about that today. It's a very large, sophisticated part of the market. And what I just want to focus on, I mean, we are a glass half empty. We're not worried about the 99% of things that is going to go right. All we worry about is the 1% that's going to go wrong. So everything we focus on is on that. So one of the key things we're looking at is non-performing assets. So these are loans where the borrower isn't paying their regular payments. There's a problem with the loan. This is some APRA data. It is very good. And what we can see here is there's 3 types of loans that they categorise: business loans, personal loans, housing loans, relatively self-explanatory. And what we've seen is that all the arrears rates, the level of non-performing loans since 2020 has fallen quite sharply. And what we're seeing in all the data is a similar theme. And that's largely a build-up of liquidity. Build-up in liquidity through stimulus, through very good trading conditions, a whole lot of factors. And I think that paints a very rosy picture around where we're at. Now, we all know that's not quite the case, that there is some challenges out there. How we see that, so we have a quarterly macro process where we go through an asset allocation committee and process around how we manage the portfolio. And we really think about it in a few different ways. So we think about governments. So the Australian government, we've got relative low debt to GDP. We've got a very good global credit rating. And the currency, the Aussie dollar is trading relatively well against other major currencies. So some good shock absorbers that if things do get harder, the Australian government entities do have a lot of firepower to sort of weather that storm. So we're not really worried about governments. Businesses, what we're seeing is that conditions are very favourable, very good trading conditions for businesses. And that's largely because capacity utilisation is very high. So some really good economics coming through, and you're seeing that in business profits. Confidence is another thing. Confidence is not fantastic. It's on long-term average, but the businesses are going quite well. The main thing we're looking at is personal. That is the big focus of where we think we'll see stress in the Australian economy. One of the, if you had to ask me, what is the one thing that we are really interested in? It's the household. What's happening in the household, and one indicator of that is obviously the household savings ratio. So that has shot up significantly, and a lot of the pent-up retail demand and consumer spending has been through just an erosion of the household savings rate. Now that can't go forever, and I think this is a really interesting point that you need to keep an eye on. And it's a bit of a case of what's bad is good and what is good is bad. So what we're seeing here is that, the household saving rate's coming down. Consumer spending just recently came out and it was positive for the March quarter, had a bad December quarter, but positive for the March quarter. And what it's telling us is that consumers aren't getting the message that they need to slow down. The government is trying to do everything they can to try and stare down the consumer and slow consumer spending more rapidly. So that's one dynamic. The other dynamic we're looking for is how people are coping with inflation in goods that they're consuming, and also higher mortgage repayments that are coming through. So it's a really interesting chart, and you've got to sort of pick away the detail to understand the implications. But I think this is something that is really, really important. And we saw the rate rise yesterday by the RBA. We've always thought that the risk is on the upside. When we look at the macro dashboard, everything is actually trending very well. It's almost like we're not having a prolific interest rate hike. And that's kind of the risk. It's good. And therefore, there is this underlying stickiness of inflation that isn't doing its job so the RBA policy isn't doing its job to slow demand. And I think that is a risk, because the higher the RBA cash rate goes, kind of the more they're upping the stakes in terms of the risk profile our economy is running. And I think that's a really important thing to keep in mind, and something we think very heavily about when we invest. So that's a bit of the state of the credit markets. So we do think arrears, we do think non-performing, we do look at things like personal insolvency, business insolvency are all going to go up. but they're going to go up probably to more long-term averages. We probably don't see it going too much further than that, but it is a time to just express caution and not look at the last 2.5 years and say, well, everything trended that way, therefore it's going to be the same going forward. It's just not the case. So that was a bit of how we see the credit markets. I guess in terms of our fund, what we're trying to do. So my background is, my last role was at a large asset consulting firm called Jana Investment Advisors. We were the advisor to institutional portfolios in Australia. There were super funds, governments, and so forth. I saw a real opportunity to do exactly what Brendan's been talking about, which is to have a product that has very strong defensive characteristics and pays investors a good rate of return consistently, but importantly does so through the cycle. So it's designed to be an anchor in portfolios. It's designed to give diversification and just a consistent level of income. So we're as a fund, we're not trying to pick interest rates. We're not trying to sort of be macro forecasters and think about what's happening in 5 years. We're actually very short-term investors. We're investing on average 12 months in credit instruments and getting what we think is a very handsome return over that period, which gives us one, flexibility, and two, it means that as the facts change, we can change how we manage that money. So this is the fund, this is the flagship fund that we manage. It's targeting RBA cash rate plus 5% net of all fees. And you can see our track record over the 7 years since the fund started. Over that time, we've never had a negative return from credit losses on a monthly basis. So we think, very conservative in how we manage that money. We've got a series of ratings and so forth, but it is designed to be, a very sort of boring product in a way, in that it's just targeting a very steady rate of return each month, with that return delivered as income. So kind of we're quite different in what we do than a lot of other funds. So a lot of other funds look at listed fixed income assets. So they're looking at trading those instruments as they're listed on the market. What we really focus on is the private market aspect of that. So what does that mean? It means that we are going to these issuers, we're going to these financial institutions directly and having direct relationships and doing direct purchasing with those issuers. So a really good example of this, we had a deal I'm working on at the moment. It's a equipment financier. They are a couple $100 million. They're growing very quickly. And they're going very quickly because the banks, APS 112, changing the capital requirements of banks. So essentially it's saying it's more expensive for banks to write a loan against car, ute, van, light truck, so forth, than it was last year. So the competitive dynamics are shifting. These lenders are growing very, very quickly. They're very well capitalized. They've got incredible credit performance. And we're going to those issuers directly and negotiating favourable terms. Importantly, those terms are what I say short dated. So typically we're investing for 12 months and we're taking security over all those underlying loans. So in that way, we're like a wholesale provider of capital with security on those underlying loans. And our role as credit professionals is to assess the quality of those loans and assess all the structural protections that we ask for to understand if that is an attractive proposition for the fund. I can go into more detail around that, but essentially what that looks like is we are essentially looking for a whole range of contractual obligations. So when we go into these relationships, they are very well documented. We get external legal counsel on transactions to make sure that legally it's a very tight transaction, but most importantly, what we're looking for is different cushions to protect our capital. And the most obvious one of that is something called subordination. So when we go into a transaction, if somebody asks for, I've got a $50 million book of loans, we won't provide $50 million against it. We might provide, say, $40 million against that. And that $10 million is their money that they need to put in. And why we like that is, one, they're very incentivized to make sure that $50 million of loans performs very strongly because their money gets hit first. And secondly, if there are problems, there are cushions or protections there to look after our capital and ensure that we get repaid in full. So it's a bit different in terms of we're not looking at listed markets, we're more looking at direct private relationships. And we think there is a very favourable market dynamic. One of the big thematics we've put in the portfolio is that our rate of return that we expect off these transactions is so-called floating rate. We've sort of speakers tonight have spoken very well about the merits of floating rate. So we're based on BBSW. So the portfolio yesterday got basically a 25 basis point increase in the yield it's paying us. So why it can do that is not only because we're pricing off BBSW, but also importantly, the loans that these originators are writing are floating rate. So they're also putting their interest rates up on these loans and we're getting a higher return as well. So it's been a very good strategy in a rapidly rising interest rate environment. It's also performed very well in a falling and a low interest rate environment, which we've witnessed over the last 7 years. So a number of reasons why we think credit is a very attractive place to be around diversification, inflation adjusted, real rate of return, steady income, low volatility, capital stability, which we've spoken about. There's an investment process we go through, which is around a top-down asset allocation, looking at different attributes of the portfolio, asset allocation, and so forth. So I probably won't go into detail. It's a little bit much. But one of the key differentiators, and one thing that I haven't met too many other managers in the Australian market, but I don't know all of them obviously, is just the depth of experience of the people behind the fund. So I'm the portfolio manager, I'm responsible for looking at all transactions, but our investment committee is made up of some of the most seasoned and experienced credit professionals in the Australian market. So it's me here, Andrew Chick. So Andrew Chick was the ex-CEO of Royal Bank of Scotland, Australia, New Zealand. He's a lawyer originally. He built up and managed very substantial loan books in the Australian market for RBS and had to manage those up and obviously had to wind those down as RBS pulled out of Australia more broadly. So very deep expertise in managing exactly the types of assets that we're investing in today. Adrian Bentley, who's our Chief Investment Officer as well, plays a very important role from an asset allocation perspective. He was the ex-head of debt finance at Macquarie Bank for 15 years, and before that, BT for 15 years in an equivalent role. The other person's Paul Edwards, who was the top credit holder for Bendigo and Adelaide Bank. He was a very large financier of non-banks in the Australian market. So it's not only, the fund, you're not only sort of getting the sort of the know-how of the investment team, but that layer of governance that it goes over us is, I think, very substantial. And that's a key way that we make sure every transaction we go into has the right level of capital protections for our investors, because that's what it's all about. We're not return seekers, we're not return optimizers, we are risk managers. And that's one of the key ways that we do that. There's a couple other staff here, including Juliet, who joins us today. So Brendan, I won't go into too much detail, but that's a little bit about us and what we do.
Appreciate that. I'll be handing over just for questions in a moment, so I don't get too far. I'm sure there's a couple. But anyway, look, appreciate the speakers for getting up and giving us some of their time today. Obviously, some fair bit of content covered in 3 different, I suppose, channels of areas that are making up portfolios for us. We've done an enormous amount of work behind the scenes in bringing these to the forefront to where we're confident enough to have conversations with clients. But the reality behind it is that a lot of this stuff is client driven, where those issues that I mentioned before, people are looking for reliable yield. There might be a bit of fatigue around equities. Where can you get a good risk adjusted return? This idea generation is something we're quite proud of and something we love putting these events on for, so we can share that with you and bring you closer to that. In the same vein as well, these are common questions. Other people will be having them elsewhere. Share it with them. People that we love to speak to or bring to these events and allow them to kind of view it as well. So Yeah, look, overall, I think personally, when you look at kind of long-term financial planning, average returns in portfolios of a balance to growth portfolios like 7 to 8%. You know, you're taking a fair bit of equity exposure for that. We are actually in a pretty rare part of the cycle where we're kind of getting close to those numbers without taking on equity risk. So I know that everyone's a lot of doom and gloom and noise around inflation and interest rates. There's always an area that is playing, and I think that, you know, there's a number of kind of stories there that were provided to us from the guys tonight that hopefully emphasize that as well. So I'll leave it there.